There's something most business owners never calculate. They watch $100,000 in revenue hit their account, then 6 months later, they can't explain where it went. It's not just taxes. That's only part of the story. There are at least 5 other places this money vanishes before you ever touch it. Most people don't realize these costs exist. Today, we're tracking every single dollar. In a moment, I'll show you the complete breakdown from the moment a client pays you to the moment you actually have money left. You'll see exactly where it disappears. This changes how you price, how you plan, and how you understand if your business is actually working. If you've ever made decent money and wondered why you felt broke, this is the answer. Most business owners operate blind because they confuse revenue with profit, and profit with the money you actually take home. They're 3 completely different numbers. Here's what happens to $100,000 in revenue. When a client pays you that amount, your first expense isn't rent or marketing, it's self-employment tax. And this is where it gets brutal. When you're a W-2 employee, your employer pays half your payroll taxes automatically, roughly 765% of your pay. You never see it disappear because someone else absorbs it. But when you're self-employed, you pay both sides. That's 153% of your net income. On $70,000 net income, $70,000 treks 9,235% treks 153% equals $9. 891 in self-employment tax. Let that number sit for a second. That's nearly $10,000 gone before federal income tax even touches you. Most people don't understand this tax exists until April. Now you owe federal income tax on top of that. And here's where bracket creep traps most business owners. You earn $70,000 net after operating costs. Your marginal tax rate, the rate on your next dollar, might be 22% or 24%. But your effective rate is much lower, maybe 1,718%. People confuse these constantly. They think they can spend their way out of taxes and end up with even less money. A married couple earning $70,000 net pays roughly $4, $900, $600 in federal tax. Not the 24% on everything. Results vary. That effective versus marginal confusion costs business owners thousands because they don't understand what income actually costs them in taxes. This is the twist that changes everything. State income tax adds another layer depending on where you live. If you're in California, New York, or New Jersey, you're paying 1,013% more in state taxes than someone in Texas or Florida. Same $70,000 income in California, roughly $6,300 in state tax. Same $70,000 in Texas, $0. That's not a small difference. That's $6,300 a year. That never makes it to your bank account because of geography. Most people miss this. When you add self-employment tax, federal income tax, and state income tax together, you've already lost roughly 4,045% of your gross revenue. On our $100,000 example, you're down to $55,000. But you still haven't paid for insurance, software, accounting, or any business operating costs. And if you have employees, employer payroll taxes come straight out of your business profit before you ever see it. One employee at $60, 0,000 cane year costs you roughly $5, $700, $6,000 in employer taxes alone. Now there's a moment most business owners catch: the quarterly estimated tax penalty. The IRS requires you to pay taxes 4 times a year: April 15th, June 15th, September 15th, January 15th. You have to send in roughly 1/4 of your annual tax bill each time. Most business owners ignore this until April and send everything at once. Then the IRS tacks on a 2% penalty per quarter for underpayment, owing $10. Talking dollars per 2% penalty per quarter for underpayment, owing $10. Talking 000 quarterly, but not paying it until April, roughly $600, $800 penalty. That's free money going to the IRS because you didn't plan correctly. This alone cost business owners thousands they could have avoided. Here's where most people leave money on the table. Deduction. Tax law gives you about a dozen deductions to reduce your burden, but roughly 70% of business owners never claim them. A home office, $5 per square foot for simplified method, up to $1,500 per year. Vehicle expenses, $0.070 per mile for 2026. That's $14,000 on 20,000 business miles. Meals with clients, 50% deductible. Software subscriptions. Continuing education. Professional services like accountants and lawyers. Most solo business owners leave $5, $0.15, $0.00 in deductions on the table every year. 20,000 business miles text $070 equals sign $14. 000 deduction text 24% bracket equals sign $3,360 in tax savings. Missing that is the equivalent of throwing $3,360 cash in the trash. Now there's a deduction that feels like getting free money back, the QBI deduction. Section 199A lets you deduct 20% of your business income from your taxable income. If you're under the income phase-out threshold, this is automatic solo business earning $80,000 in net income. 20% times $80,000 equals $16,000 deduction equals $3. 840 tax savings at 24% bracket. That's $1 of every $5 in business profit that's not taxed. Most people have no idea this deduction exists. But here's where people actually save serious money. The S-Corp election. When you elect to be taxed as an S-Corp, you split your income into two buckets: wages subject to payroll taxes and distributions not subject to self-employment tax. The IRS requires you pay yourself reasonable compensation as wages, but everything above that avoids the 15.3% self-employment tax. A business earning $200,000 in net income, pay yourself $100,000 in wages, take $100,000 in distributions. Wages are subject to SE tax, $14,500. Distributions avoid it completely. Total SE tax drops from roughly $29,000 to $14,500, which equals $14,500 saved. Subtract the costs of an S-Corp election and extra tax filing, roughly $3,500 per year, and you still save $11,000. Most business owners with income over $80,000 should be doing this, but they're not. The catch is reasonable compensation. The IRS defines it as what a similar business would pay for similar services. If you're running a consulting firm earning $200,000, but only pay yourself $40,000 and take $160,000 in distributions, the IRS will challenge you. They'll say, your reasonable compensation is $120,000. Then you owe back taxes on the reclassified amount plus interest and penalties. Court precedent. Watson PC v. United States established that compensation must be defensible based on industry standards. It's legal optimization, not tax evasion. But you have to do it correctly. Now let's track everything else that disappeared. Insurance, professional liability, $1,000 to $2,000. Disability insurance, $1,500 to $3,000. Health insurance, $4,000 to $8,000. If self-funding, that's $6,000 to $12,000 per year, just for basic protection. Software and tools, QuickBooks, $400. Email CRM, $300. Project management, $200. Add up to $1,100 minimum. Professional services, CPA or bookkeeper, $3,000 to $5,000. Occasional legal review, $1,000 to $2,000. Another $4,000 to $7,000. Marketing and web hosting, $300. Email platform, $200 to $500. Content creation, $2,000 to $5,000. Results vary depending on industry. By the time you account for all of this, operating costs alone consume 15 to 30% of gross revenue before you calculate taxes on $100,000 revenue. That's $15,000 to $30,000 gone to business infrastructure. Let me show you the complete picture. Starting with $100,000 in client payments, you spend $30,000 on operating costs, leaving $70,000 net income. Self-employment tax takes $9,891. Federal income tax, assuming 24% bracket on taxable income, takes roughly $15,680. State income tax variable by location takes roughly $6,300. After all taxes, you have $38,129. Then insurance, $2,500. Software, $1,100. Professional services, $3,000. Marketing, $2,000. And health insurance, $5,000. Comes out. You're left with roughly $21,529. That's 21.5% of your original $100,000 revenue. You literally keep $1 out of every $5 you earn. Everything else evaporates. This is why operating margin matters so much. If you operate with 30% net margin, you're taking home roughly 21 to 25% after everything. If you operate at 50% net margin, you're taking home 35 to 40%. A service business with thin margins collapses because the math doesn't work. A product business with higher margins survives because it has room to breathe. Most business owners don't understand this until they're 6 months in and wondering why they're broke despite making 6 figures. Here's how to actually fix this. First, raise your prices 20 to 30%. Most business owners underprice by 25%. If your competitor charges $12,000 for the same project you charge $10,000 for, a price increase to $12,000 means an extra $2,000 in revenue. Extra $2,000 in revenue times 24% tax rate equals net $1,520 to your pocket. Second, elect S-Corp status if you're making over $80,000 per year. The savings are real and legal. Third, claim every deduction you're allowed. Home office, vehicle miles, software, education, meals with clients. If you drive 20,000 business miles and never claim the deduction, you're leaving $3,360 in tax savings on the table. Fourth, separate your business and personal finances completely. Open a separate business bank account. Use accounting software like QuickBooks. Categorize every expense. Many business owners lose $2,000 to $5,000 in deductions because they can't document what was business versus personal. Fifth, plan for quarterly taxes. Set aside 30% of monthly net profit. Deposit it quarterly. This avoids penalties, interest charges, and the April scramble. Sixth, consider a solo 401k. If you're self-employed, you can contribute up to $23,500 as employee deferral and up to 20% of net self-employment income as employer contribution. Total potential for 2026, roughly $69,000 depending on income. A solo 401k contribution of $50,000 times 24% tax bracket equals $12,000 in tax savings. That's pre-tax retirement savings that also reduces your taxable income the year you contributed. Seventh, hire a professional. A CPA costs $2,000 to $3,000 per year and typically saves $8,000 to $15,000 in taxes through strategy and missed deductions. That's a 3-to-1 to 5-to-1 return. It's the best business investment you can make. Now here's what most people get wrong about the paycheck trap. It's not a trap set by malicious people, it's just the reality of being self-employed. You pay both sides of payroll tax. You're responsible for both employer and employee contributions. You have to fund your own health insurance, retirement, and benefits. Most of that responsibility is absorbed by W-2 employers. When you're self-employed, it falls on you. This is why $100,000 in business revenue doesn't feel like $100,000 in wealth, because it isn't. The businesses that fail are the ones that didn't plan for this. They saw $100,000 in revenue and thought they had $100,000 to spend. They didn't. They thought they earned $80,000 after operating costs and could spend like they made $80,000. They didn't account for $27,000 in taxes and overhead. By the time April rolled around or an unexpected expense hit, they were in crisis mode. The businesses that survive are the ones that understand the real math from day one. They know $100,000 revenue equals roughly $20,000 to $25,000 net after all costs. They price accordingly. They build cash reserves. They don't confuse revenue with actual income. They work with accountants who run the numbers before they make big decisions. One last layer, this compounds over time. A consultant earning $150,000 in revenue and missing $8,000 in deduction savings. Doesn't seem catastrophic, but over 10 years, that's $80,000 in unnecessary taxes. A service business operating at 25% margin instead of 35% margin seems fine. Year one. But over 5 years, it's the difference between building a business worth $500,000 and one worth $2 million. These small percentage differences in tax and margin efficiency compound massively. 3 things to remember from this breakdown. Revenue and profit are not the same. Plan for taxes quarterly, not April. Hire professionals. They pay for themselves. If you want to apply this to your actual numbers, we've built a free calculator in the description. Plug in your revenue, operating costs, and location, and it shows you exactly where your money goes and how much you're actually keeping. No email required. Just download it and use it.